to this session on balancing data science innovation and governance in financial service and insurance. My name is Kjell Carlsson. I'm head of Data Science Strategy and Evangelism here at Domino Data Lab, but I was also previously a analyst at Forrester Research covering data science, machine learning, and artificial intelligence. And it is my great pleasure to introduce you to two guest speakers today. The first is Peter Wannemacher, who is my former colleague over at Forrester Research. He's also the very first person I know to have gotten a degree that was explicitly in data science. He saw this coming way before any of the rest of us did. Peter, would you like to introduce yourself?
Yeah, thank you very much. I'm very happy to be here. Thank you to Domino for having me, and to Paul and to you for joining me on this. I'm a principal analyst at Forrester. I focus on financial services, and really looking forward to this discussion. Thank you very much.
Thank you. And we're also particularly lucky to have with us Paul Nothard, who I feel like my career and his career were on parallel trajectories throughout most of it. But over and over again, whenever there was a decision that was made to go and delve deeper on the artificial intelligence side of things and to make that right choice, he made the right choice, and I often didn't always make that right choice. Paul, would you like to introduce yourself?
Yeah, thank you for having me. It's Paul Nothard. I've been at VMware quite a long time. I am working in the global financial services group as a solutions architect. And what I do is I just talk to all our customers within financial services about all things tech, really. My background is in banking, so I've worked for various capital markets firms. I didn't do a degree in artificial intelligence, but I did do a large module in it. I just chose not to, unfortunately. But that's my bit of my background.
Well, at the time, it was exactly the right thing to do. Since then, artificial intelligence has proven us wrong, and all of that work over on neural networks has become incredibly useful and powerful in a way that few of us could have foreseen just a decade ago.
Tech has caught up.
Indeed. Yeah. We'll be talking more about this, and we will be having a panel discussion where we'll be delving into a range of questions on the latest trends when it comes to data science in financial services and insurance. We'll be going over and talking about the particular challenges that leaders in the space are facing, and ways in which folks are looking to scale data science and machine learning. But before we do that, Peter has been very gracious to comb through all of the research that Forrester has and the survey data that Forrester has, and to share with us some of that data to give us a sense of the context of how organizations are looking at data science, how individuals are viewing the sharing of their data and the monetization of their data, to start off our conversation. Peter, would you like to take it away?
Thank you very much. I'm going to talk through just a few insights from Forrester's research. We have unsurprisingly, a lot of research and a lot of data on data science, on AI, on ML, and a lot specifically within financial services. And I'm going to talk through all of that. We're going to kind of take a quick outside-in tour of what we're seeing. And when I say outside-in, I'm talking about we're going to start with the end user, the customers and prospects of banks, financial institutions, insurers, really all the companies playing in the financial services and insurance space. So I want to start with the sense of trust that consumers have with different types of companies. Data science and utilizing AI and ML doesn't require always customers to be active participants in that. But at a certain level, certainly at a fundamental level, you need to have their trust. There's a mix of good news and bad news, according to our research. The good news is that banks, or particularly my bank, is one of the most trusted types of companies. When we ask consumers which companies they trust to keep their personal information secure, aka their data, my bank and other financial service companies go high on the list. The bad news, of course, is it's still not even a majority of consumers, right? So that relatively speaking, in the parentheses of this headline, is doing a lot of work here. So I think there is some work to be done to ensure and even nurture trust with consumers, with customers, especially in financial services, in banking, in insurance, with those customers, and even with prospects, that you can be proper stewards and utilizers of their data and of various data sources. But there's some work to be done there. Another angle on this, and one that Forrester has looked at a lot, is the data for value exchange. It's one that's been rightly a topic of discussion in business, in financial services for a long time. I mean, I would submit probably a decade or so we've been talking about this, and it's becoming increasingly evident. So this data, just to be upfront, this is across industries. I think that's actually a more useful way to look at this particular data. We're asking people what would motivate them to share more of their data, their personal information with any kind of company. And when we looked at this, we asked about a bunch of different ways. The noteworthy point here is that a majority of everyone in Gen X and younger is willing to exchange data for some type of value. There's something that would motivate them to exchange that more. It's noteworthy that boomers and folks older than boomers are below 50%, but even there, it's well above a third of customers. This, I think, only strengthens the view, sort of underlines the point that this will become increasingly important. I mean, it's important because of the shifts in technology, right? We're going to spend the next 30 plus minutes talking about, having a panel discussion about AI and ML in financial services and data science in financial services. But a big part of it is customers' willingness to let you utilize their data, the data that you already have about them that you're using, and in some cases giving you access to more of the data. I thought it would be helpful to very quickly give you a sense of how Forrester thinks about data monetization and data commercialization. So I'm going to give you both of those definitions. So the first one is data monetization, the process of leveraging your data. In this case, we're talking about the companies. It might be consumers' data ultimately, but data that the company has access to, or in some cases actually owns, to produce insights and decisions that grow revenue and improve your business. And I don't want to say contrast, but another variation of this umbrella concept of sort of making the most of data and using data to drive better business outcomes is data commercialization, which we define as the act of creating a data product through packaging, pricing, and selling data to other organizations. So there is certainly an important distinction in there. And then before we get into our panel discussion, I thought it'd be useful to quickly give you a sense of how financial services companies are thinking about data monetization, and in particular AI and ML as part of their business strategies. So we ask executives and leaders at financial service companies and at other firms, as I'll show you in the next set of data insights. We ask them about a number of different technologies and technology categories and processes. And in this case, we're asking them about their use of AI, which includes machine learning, explicitly includes it in our surveys. So what's noteworthy here is that 40% of financial services providers globally have already implemented AI. And that, again, includes machine learning. And 76% have either already implemented or will be in the next year, right? And remember, this is across all financial services. And I think this indicates the growing, not just interest. I mean, I think there's been interest for 12 years. And there's been certainly data science as some aspect of financial services, but really an interest in and a willingness to put money behind AI and ML as part of their data science and part of their broader business efforts. I thought it'd be useful to set the stage for our audience and for our discussion by giving you a sense, all of us a sense of how financial services looks compared to other industries. So I'm giving you a sense of financial services, which is in the light blue, and all industries, which is in the dark blue. And what's really noteworthy here is that more than 1 in 5 financial service companies have already implemented some form of AI ML and plan to expand those efforts. and that's compared to just 17% of non-FS firms. And so what we're seeing, I mean, the sort of bottom line here is there's a willingness within financial services to not just consider the possibilities of AI, not just put some money into data science, but really think about the role that data science, AI, and ML can play in banks and insurers and financial service companies' business strategies and broader business initiatives. So with that, I'll hand it back to you.
Oh, thank you very much, Peter. I guess would it be fair to summarize what you've been seeing in those statistics as saying that, well, customers are willing to share this data that banks and insurance companies are collecting around them, and they're willing to share that in exchange for innovation, new products and services, and experiences that delight them in their interactions. And that on the leader side of things, there is arguably more than ever before a desire to go in and exploit and use that data. Is that roughly what we should be taking away?
Yes. I mean, the bottom line is yes. I will make one note, which is on the first part of what you said. Customers don't care at all about innovation for innovation's sake. I don't think that's what you. Certainly not what you were going for there. But it is absolutely true that there's not a blind trust. There has to be some value for them, benefit for them. That's in some sense always been true, but it's increasingly true. And then yes, on the flip side of that, there's a willingness. I mean, I think, let's be honest, FIs have always been willing to exploit data. I think they're recognizing the potential to utilize data in new ways, using new systems and new processes. So yeah, I mean, I think you could say 10 years ago, FIs knew they were going to make a big bet on AI and ML and data science. Increasingly, they're making that big bet. And by the way, I think in some sense, even the word bet, I wordsmith you a little. Maybe I should wordsmith myself here. It's not really a bet anymore. It's really an investment and a willingness to really go in there.
And I guess I'm curious how you're seeing this come up in conversations that you're having with executives at financial services and insurance companies. Is this one of a maturation, a movement from, well, we've been investing in the information architecture, we've been investing in our ability to provide access and store that data, to one where now we're looking to go to invest in our ability to go in and analyze that data and drive new experiences and automation off of that data. What are you hearing from them?
So here's my sort of high-level view is on an industry level, and I mean industries, but it is, yes, there is an industry-wide maturation happening. So I think that's evident. It really is evident. I mean, I talk to mid-sized banks, small insurers. I talk to credit unions who are recognizing this shift, and I mean, it's often in partnership with technology companies. So on an industry level, then within those industries, it is not homogeneous at all. And what I mean by that is there's very different skill sets. There's very different the approach they're taking. So as I said, on an industry level, there's this sort of shift in maturity, shift in willingness. I showed you the data. Within each company, there's very different views on what shape this will take. So what are we going to use this for? So maybe this is one way to summarize it is, the idea that we're going to use data, not just store it, not just have it, not just make sure that our regulators know that we have it and we're keeping it safe, which is important, necessary, but actually utilize it to improve customers' experiences and business outcomes. That's an industry-wide shift. Within that, what they're going to do with that data and what types of AI, what types of ML they're going to utilize is very different. Will it be used for use cases that are exposed to the customer? Will it be only internal processes? Will it be around, I mean, certainly there's big questions around, is it credit decisioning? Is it the one that's had the most exposure but not been all that advanced is in the marketing angle of this. And I'm not pish-poshing that, but I think we'll see a lot of interesting stuff happen that's outside of marketing, that's inside internal processes, and that's where that varies a lot by firm.
Excellent. Paul, curious on your side, whether or not, are you seeing the same things? Are you seeing certain things stand out in terms of either what's keeping folks up at night, or in terms of what folks are aspiring to do or looking to do that is different now than if we were to look back at just a couple of years ago?
I mean, broad brush, I agree with everything that's said. I think some of the things I would add is that people are, how can I put this politely? It's been a little bit of the Wild West for a while. Lots of people, shadow IT was a thing for a while. What we've got is we've got shadow AI ML. So we've got lots of people doing really cool stuff and actually making a business impact. Now, whether that's being run the bank, internal process, or whether that be customer facing, know your customer sort of things. And applying some of the, retail, if you take the lessons from retail, they've done a fantastic job at pulling in data from your club cards, augmenting that with your Bluetooth location, your face recognition to understand your mood. Banking and insurance are picking up on exactly that. Now, what I'm seeing is there's a little bit of inertia for people to take this Wild West data, which is cool, but then trusting it. So there's a situation just now where if I get 3 models, and they come out with 3 slightly different answers, which one do I believe? So it's all about, industrializing it now and bringing to bear the data to actually use it in anger in situations that are very important. And that ties in with the next thing that I'm going to talk about, I'm sure, is around the regulatory frameworks. So the regulatory frameworks, without jumping into them now, one of the big ones that I hear a lot of people talking about is the upcoming explainable AI sort of conversations. Because if you're making life decisions for people, you need to be able to have some proof behind it. And there's some fascinating debates about, what creates a decision. If you're underwriting, what decisions do you make? Do you charge more for a red car insurance, or do you charge more for a pink car insurance or a black car insurance? And then you've got all these secondary effects that you have to explain. And it's a fascinating area to get into. But what I am seeing is people are slowly but surely overcoming the inertia to put things like this into real world scenarios and really crank the handle and use it in anger across customers and internal processes.
Well, I'd like to delve into one of the things that you said there, which it sounded to me like when we talk about trust and data, it's often a question about access to the data, the quality of the data, and obviously that's important. But one of the things that I feel like I heard you say is that a lot of this is also just about the reliability, the process discipline, making the data and our data pipelines and our machine learning pipelines reliable enough and regular enough so that we can make make the data and make the data science models work for us and be used in applications in a way that's not going to break and that are not going to get us in trouble with, obviously not get us in trouble with regulators, but even before we get to that part, just make sure that they actually work and that they are reliable for organizational processes. Am I hearing that correctly?
You're hearing it absolutely correctly. It is fascinating, the stats that Peter put up earlier about the trust figures, the fact that you trust your bank very highly, but you don't trust your technology firms. And if I recall correctly, you trust Amazon more than you trust technology firms. That's interesting because they're selling your data almost certainly. But that's another story. When it comes to understanding what data you have, where you put it, what you're giving up for, because it's a bargain between the consumer and the business. That's the bargain you're making. And when you make the bargain with the devil or whoever, you need to be able to get a positive return from it, but you also don't want to give up information that's going to exist in the public domain potentially that can then down the line impact something. So, for example, I'll take a silly example, and this would not happen for the record, but if your bank were to realise that you're buying lots of, making it up on the spot, crazy fireworks and all sorts of, bungee jumping activities, etc. But then if that data got into the realms of the life insurance companies, does that mean to say that they can then take advantage of that? Now, the very clear demonstrable answer is no, they are not allowed to do that. But at the same time, the insurance companies need to take all legally available data to understand it. So what we're looking to do is essentially control the data. And from a customer perspective, to get that trust level higher, we want to industrialize processes so that when I give up my data, I'm doing it in a way to my bank that I trust, and I trust the technology to A, make the right decision, and B, keep my data safe, because I don't want it leaking out.
I mean, there's almost a way in which it sounds like there's a connection between governance and regulation and trust, in the sense of maybe one of the reasons why customers are particularly willing to trust their bank is actually because of that regulation. And by extension of this, that banks, through their investment in their own internal governance processes and their own internal efforts to, for lack of a term, regularize or industrialize their use of this data, actually is a way of driving a virtuous circle of actually increasing trust and increasing the development of value from that. Or am I reading too much into it?
No, I think you're correct. It's all about, demonstrable proof that you were doing the right thing with the data, so that, you say you trust your money in a bank. You do that for a reason, because you know it's safe. What you want to be able to do is you want to be able to trust your data with the bank so that they can make the best use of it so that you can get benefits. So when I go into my supermarket, they know what I'm going to buy. Therefore, they will give me preferential discounts on whether it be chicken or whatever I had last week, to try and obviously up the market share because they're not a charity. But at the same time, there's this transaction that goes on. The same is happening in the banking and the whole financial sector. If you're wanting to give the data, you need to industrialize it. You need to create the process behind it, so that not only do you build the trust in the consumers giving the data so that they will willingly do it, but you will trust the results more. And I think that's the key thing, because if you trust the results more, you can then put those results into, not in a bad way, but more dangerous situations. You have to, as a company, have the confidence that you're making the right decision based on a confident decision-making process.
Well, I guess
that's about industrializing the whole process that we're talking about, really.
Well, I guess for both of you, I'm curious whether or not we should be viewing that trust conversation just as much about trust with internal stakeholders and business leaders as we should with customers. That same kind of dynamic around trust and reliability is exactly what's playing out internally in organizations, and when it comes to stakeholder adoption and willingness to go in and not just develop these data science and machine learning based solutions, which we know that there've been POCs aplenty, but actually go in and make this part of their businesses and the foundation of their businesses. That trust aspect is just as important for the internal market, so to speak, as the external one.
For my money, the answer is it is equally important. It's just as important. I agree with that. I think they are two distinct two distinct audiences, right? The way in which your internal stakeholders, and even we say internal, also your partners. Some of your partners are captive audience, and they just they're going to do what you say, and it's part of a contract. But there's ecosystem partners, and especially within financial services, that's been a mainstay of this industry or industries for 50 years, probably 75 years. But they are two distinct. The way in which you nurture trust. So actually, I'll go back to what Paul said about there's this exchange, which I mentioned in the data as well. I will note that some wider research we have shows that. So I showed data showing that younger people are more willing to exchange data for value. They're also, and Paul, you can tell me if this aligns with what you've seen, or both of you should tell me whether this aligns with what you've seen. We have wider research or other research that shows that younger people are more aware, sort of conscious of that exchange. They may not think about it all the time. They may not use the language that the three of us or companies use, but they are more aware of it than older customers. So that the way in which you speak to the end user about you can trust me with your data, and the outcomes, to Paul's point, those models of the data, the way we utilize the data is a different. To your point, Kjell, I think they are of equal weight and equal importance to success, but they're very different conversations.
Yeah, I think that would be fair. And what's interesting is when we talk about trust, it's not just trust about the data that you're giving up as that part of that transaction. But if you look at what we're using all of this AI ML for in the real world, within what real companies are doing with it within the financial sector, some of it isn't actually based upon customer data per se, and yet we still have to trust the outcomes. So if I take, for example, if I'm going to insure my car, that part of it is depending on your profile, etc. But it also depends where you live. Now, that is a statistical calculation that is based upon a variety of things. So what we need to do is we need to just understand the trust model of, regardless of where the data comes from, but do we trust the outcome? Now, the way we trust the outcome is all about that data process. It's all about cleansing the data. It's all about putting it in the pipeline in a very formulaic way so that we get repeatable results. If I get repeatable results, I'm therefore statistically more confident in the outcome. It's exactly the same as weather forecasting to a greater or lesser extent. If it's a chaotic model, you can tell, and then you know it's not going to rain tomorrow, or it might rain, but we're not sure. It's all about understanding that statistical accuracy. What is the truth factor in there, I guess? It's interesting.
Indeed. I would like to move us towards, well, so how organizations are now turning this into a reliable, scalable capability. I'm curious, and also at the same time, naturally promoting innovation. When it comes to that strategy, what are you seeing in organizations? Are they up-leveling that strategy so that more senior level executives are becoming involved in this and taking ownership of that strategy? Is this very much a bottoms-up driven, let's see the innovation that springs up in different parts of the organization, and we will then maybe try and manage it and gatekeep it from above? What are you seeing organizations do in terms of creating a strategy to go in and unlock this value and up this opportunity?
So what I'm observing is a bit of both, and it depends on where that company is upon the whole curve. But on one hand, you've got companies that are, they have a huge amount of statistical data gathered over many, many, many years that they're trying to arguably monetize, or at least use that data to de-risk their business and make better business decisions. So they are the data-rich companies that I see. Now, a lot of them tend to be, without making broad brush statements, but they tend to be a little bit more risk averse in things. So they won't be going out and doing the crazy, sort of hiring, 400 data scientists and go see what you figure out. That's not going to happen. But they are dipping their feet in the water to try and understand what they can get. Now, this has been happening for a number of years, as we all know. But what they're finding is they're getting real results out of it that can predict certain things that make their business A, better, B, more profitable, more compliant, etc., etc. But what they're now doing is they're looking to industrialize that and ramp it up and do it in a very formulaic, controlled, compliant way. And we'll get onto it, but some of the rules and regulations that are evolving as a result of this are making them make decisions that will have an impact on them in about 3-4 years. And they need to decide about what's happening now. Now, the other side of the coin is some of the relatively newer companies. They need to act fast. They need to really be agile. They need to spin things up, fail fast. It's that fail fast mentality. So they will spin things up, and they'll just go into, pick your favorite cloud, run a few models, rent by the hour. Oh, that works. Brilliant. Let's use it. And then they'll kind of scale it a bit that way. But they tend to be a bit more lean, mean, and that model works. But you have to be careful, because at some point you're going to hit the heel when they have to turn it from I guess, a bit of a prospecting way of playing with the data to actually realizing we've got something here, let's industrialize it and let's scale it up, and it becomes, a recurring calculation. That's a fascinating dynamic, because they might have been a bit more out in the cloud, shall we call it, doing things very agile, but they're now getting to a point where they need to be a bit more formulaic. And that transition's fascinating to watch. Obviously, I'm biased. I think we can help them, and we have very good answers. We wouldn't be here otherwise. But at the same time, there is a general industry trend that people are getting over that inertia of trust. We've got the trust coming. Therefore, more and more people are taking these models by these data scientists who are out there doing things, and then putting them into production and running their business by them, and putting them front of house in front of customers, because they trust them. So we're on that journey, and various companies are further down the line than others, but there's a very definite general trend to doing a lot more with data this way.
Something that Paul said that I want to key into, if it's all right, just very quickly, is the seeing. This is a few minutes ago, Paul. You said seeing real results. I have not done this, but I don't have hard data to prove this, but I think every bank, insurer, wealth management company I speak to in the past, let's say, year and a half, has a real example of impact from data science, AI, ML within their business. They didn't always invent the model, right? It's not uncommon that they're utilizing someone else's, but real and enterprise-wide effects on their business. That's something that the potential for all of this was evident 10 years ago, as Paul mentioned, but the being able to point to real results is absolutely evident in my conversations. And like I said, I didn't go out and do this survey, but I feel if I did, I'd be able to point to it. It's not always some advanced AI model. Sometimes it's just more traditional data science. But I think that's what we've seen. Forrester has seen, and that mirrors that. And then the other point I'd want to key into on what you said is the risk averse. The place where I see them being most, meaning financial institutions being most risk averse, is around regulation. So the idea of being able to try out a few different models and see what works and what doesn't, I'll use the word, I think you used it earlier, is a dangerous proposition if you're putting it in real world. Like, let's say you said we're in 10 states. And we're going to test different models in different states. You could find yourself in some hot water depending on it could be the makeup, the economic or racial makeup of those different states. It could be, I don't know I don't know of any example where that's happened, but that aversion to that kind of regulatory risk is very real.
Well, it sounds like from what you're describing, there are at least two successful archetypes. And one of them is an organization that has been monetizing, commercializing their data for a long time, and which has very entrenched processes around data governance. And the process of developing new products, new opportunities to monetize that data, it can be very, very slow and difficult because you're working within a structure that has been built up over years and years that isn't necessarily may or may not be leveraging the latest and greatest on the data science and machine learning side of things. It was built probably around earlier generations of techniques, very rules-based, et cetera, where you have a lot of control over what it is that you're doing. But those organizations, they have the reliability and process controls and checks in place. It might take them forever to come out with a new product, but they're used to driving value off of their data. So you've got that as one archetype. It sounds like as another archetype is the born digital organization, where it's all about rapid innovation, throwing things against the wall, getting it out into production really as almost as soon as you can, and iterating and seeing what sticks. Is it fair to say that you're sort of seeing those two groups, or
Yes.
are there other archetypes emerging? And I guess I'm curious your view on is one better than the other, or is this one of the things of no? Actually, it's embrace the diversity, embrace and work from there.
Yeah, it's absolutely a continuum. On one hand, you've got what you would politely call the Luddites at one side, and then you've got the other side, the cowboys. Yeah. So it's a very, very wide spectrum. But what you tend to find is the people who might be more traditional, if they're wanting to evolve their business, as most are, because there's a whole digital transformation going on, as we all know, what they can do, and a number of banks, big banks I know have done this, is they've started up smaller companies within the big bank. And what they operate as they operate almost like a little startup within the bank. It's these innovation companies within the big bank, and then once it's good, they'll fold it back. That's quite a popular method. But you do literally have a bit of tension between the two management styles. So that can be fun to watch, and it works very well if done correctly. And there's some very good examples I can't name here, but Some great examples where they've started doing B2B business out in the Far East, and then they've pulled that sort of methodology back to EMEA, AMER, etc., to kind of roll out to the bricks and mortar sort of style. But on the other side, there are a few of these companies, the fintechs who have been born in the cloud, that are starting to go, okay, I've done this very quickly. I need to now adhere to some of the regulations. And some of them, well, they've always been adhering to them, of course, because they'd go out of business. But some of the regulations coming up, they've had a tap on the shoulder from the regulator saying, what's your exit strategy? What happens if things go wrong? I'm now, as a regulator, I'm now relying upon this financial data on various instruments that you're providing to the wider market. You're now a critical part of that trade flow, for example. And they're being asked, so how do I get from here to here? And that's a fascinating conversation as well. Obviously, we can help out. Yeah, it's a really interesting time to be there. And what we can do is we can, where appropriate, help a particular business move to a slightly different model and give them choice while remaining compliant with all the existing and future regulations. That's the plan. So that's what we're about, really.
Mm. Well, so it sounds like for a lot of organizations, they're in this realm of, and we've seen this over and over again across industries, it's no longer a question of proof of concept. We have the success stories. It's now just a question of how do we scale from this? How do we get more of those success stories? How do we ensure, because our current manual processes for both creating and operationalizing them, but also are very, shall we, tried and true, but maybe not necessarily best applied processes for governance, or adapted processes for governance are in the way. Curious then what you're seeing in terms of emerging best practices for scaling and operationalizing with governance in organizations.
So it's about choice. What it comes down to is giving you the choice to do the right thing with your model at the right time, make it repeatable, so it's all about automation. All of these things will ring true with a lot of the risk managers because it's about de-risking things. The way you de-risk things is you copy exact and you do the same thing each time. It's repeatable and you know where you're going. Now, when you do that, you're removing all the variables. So whether that be starting right at the beginning of the pipeline, having a common data pool from which to get your data, that's all about the management of the input data. That is a task in itself that you need to manage. Now, you know, we can't beat physics. If you're putting this data in 10 places all over the world, how do you know it's going to be accurate each time? So these 10 different geographically dispersed models are all acting upon the same data. So you have to bring some governance and control to that. And the data replication, I won't get all technical and boring here, but data replication is an issue just to understand that you've got a golden copy of the data, for example. Once you move down the pipeline, what you need to do is you need to put things in the right place at the right time. Now, right is a simple word, but how do you define what is the right or the correct place? You have to adhere to the laws of physics. You have to adhere to the laws of the land. So we know that there's this data gravity conversation. If I've got data somewhere, you know, I either bring the data to the compute or the compute to the data. Now, the size of your data, the location of your data, and where you're allowed to take the data will determine a lot of the time what you can do with that data, and therefore where the compute comes in. Now, diving a little deeper, this is where we start talking about the hybridity conversations around the hybridity of cloud. You might start something with a bit of synthetic data in the cloud, prove your models, prototype it, you know, kick the tires a bit, understand what's going on. You might then spin it up with some real data if you're in an appropriate place, literally, for that data. So, for example, if you're a Canadian citizen, you can't, or Canadian company, you cannot take personal data outside of Canada. So when you're doing this, you need to have the guardrails to say, when I press go on this model using this real Canadian citizen data, it cannot move outside, etc. So those are the sorts of rules that you have to adhere to. When you want to kind of productionize that, typically, not always, but typically what I'm seeing is where you want to run things really tight, really efficient, really controlled, more and more people are doing this slightly counter-popular thing of moving things back on premises. I'm biased, of course. I absolutely embrace the multi-cloud, the hybrid cloud story, but I'm absolutely about choice. And it's about being able to move where the correct place is at the correct time. There are some cases it will be on premises. There will some cases it's off premises. But typically what I'm seeing is where you start to industrialize processes and you don't want to have a huge amount of extra controls or managing a separate system or et cetera, et cetera. A lot of people, they have what they know and they know what they love, and they will put it back on premises, and then they'll have the steady state running on premises. That's kind of what I'm seeing. But once you get into that situation, it then allows you to, and it's all back down to choice, it then allows you to have the choice to burst out where appropriate to, for example, a sovereign cloud, should you require very, very tight control, or a cloud in a geography of your choice. Yeah.
Well, to probably quite a large degree, we've seen this story before. So that migration from on-prem to the cloud and then towards a more unified strategy around hybrid cloud and multi-cloud. We've seen that story play out on the servers and compute side of things. We've seen that play out on storage. We've seen that even now play out in analytical databases. Arguably, it's only been a matter of time before that happens on the data science and machine learning side of things. I mean, it's always struck me that, well, yes, adopting a cloud first, cloud has a lot of benefits when it comes to rapid development and prototyping, and whether that be on training your data science models or whether that applies to application development. It's then once your training workloads become of such a scale on the data science side, or when even your inferencing workloads now start becoming of such a scale, now it becomes all the more important to think about, well, what are the cost implications of this? But it sounds like it's not just the cost implications of this, it's also the data privacy, data sovereignty regulations around this, but also we shouldn't forget the application characteristics, the physics, if you will. The latency that you're going to need for your application is going to determine where your model resides and where you're doing your inferencing. Am I hearing you correctly on that?
Yes. So if you're in a capital market situation and you're doing, for example, if you're doing yield to maturity curves or things like that, or you're doing clever Petri models within that space, you need it close to the exchange. It's, you know, these are the sort of physics that you have to deal with. But where you're looking at spreading it across multiple clouds, you have to do that in the right way. And there are some, you know, looking back to the kind of regulatory side, the regulators are getting increasingly worried about what they're calling concentration risk. Now, concentration risk is a thing that's been about in financial services forever, but it's typically applied to your investments. So if I'm investing in 5 different funds, do they all come down to one single fund that is, I'm not going to choose a country or a fund, but, you know, is it all coming down to one particular place, in which case all of those funds have a concentration risk on that one. It's exactly the same in IT. Now, if you go back like me, who's a little bit older, and you go back into the 90s, we used to have multi-vendor strategies where I wouldn't necessarily trust vendor A versus vendor B, so we'd buy both. What then happened is we discovered that was very hard to manage. So we went, and there was a trust, it all comes down to trust. We all then went to commodity hardware because we could swap it in and out quite easily. So there was less of a trust issue. We're seeing exactly the same with clouds evolving just now. If you want to just use the old, you know, adage, you don't want to put all your eggs in one basket. Or more to the point, if you do put all your eggs in one basket, you want to have a strategy to take those eggs out and put them in another basket in 2 ways, one in a stressed exit and the other in a managed exit. The stressed exit is what we all know in the industry as business continuity and disaster recovery. If something goes wrong, badly wrong, you need to run it elsewhere. So you need to be able to get out of your said location, whether that be on premises, at the edge, or in a cloud. You need to be able to have a disaster recovery. But what happens if there's let's say, a geopolitical situation? It's quite topical in Europe at the moment, as you can imagine. So if you've got a geopolitical situation where a bad actor might be deliberately focusing on one particular vendor that could possibly impact someone, so quoting the UK government, so this is all public knowledge within a UK government white paper, they're talking about there is a concentration risk, or there was a concentration risk on a particular cloud provider, that if this cloud provider went down, I think the figure was 65% of UK retail front-end banking would stop. That's a bit of an issue. Now, it's all about proportionality. You'll see in all the regulations that are coming up, they talk about the proportionality of a risk happening. But we all know when you're doing risk calculations, you multiply, the probability of it happening with the outcome and how bad that outcome is. So if it's very likely to happen and the outcome is, who cares, that's okay, that's fine. If it's very, very unlikely to happen, but the outcome is, uh-oh, we crash the bank, that's a big deal. What happens if the outcome is, if this happens and, uh-oh, we crash the economy of a single country? That's why the regulators are getting very interested. Now, there was a situation a few years ago, I won't go into names, but there was a particular provider that had an issue with the various edge caching content of a whole load of databases. So it's all about content delivery. Very, very simple thing happened. It turned out that about 4 news outlets, I think Yahoo was affected, MSN was affected, various other big websites were affected, all completely unrelated, but they still used this caching mechanism. Now, the good companies, just calling out the BBC here, they were up and ready, within a matter of, I think it was about 15 minutes, they were able to flick a switch and then move over to the other supplier. But others weren't so fortunate. So they lost business. They directly lost business. Nothing to do with the cloud provider they were using, nothing to do with their data center if they were local. It was to do with the concentration risk of a third party. Now, in this case, within financial services, that's not so much of a worry about that situation. But there are situations, whether it be clouds, whether it be other providers, you need to watch out for that. Not avoid it, but do it in the correct way with an understanding of the risk. And where the risk is very high, because I've taken this cool AI/ML process and I've productionized it and I've put it over here and I've industrialized it, but I've not moved it into an appropriate place where there is the whole operational resilience side of it going on. If there's a problem, whether it be disaster recovery, or if there's a problem because a cloud provider has an issue or something in the chain breaks, then we have an issue. So the regulators they're about to push, all the documents are going through, both the EU, the UK, and there are similar things happening in the US, talking about concentration risk.
So it sounds like the ability to be able to operate across multiple different environments, whether they be on-prem or in the cloud or across multiple clouds or definitely multiple regions within a single cloud, all of this extremely important from a reliability as well as and risk point of view, and by extension also regulatory point of view. Curious whether or not it's also particularly helpful when it comes to being able to spread data science and machine learning to other parts of the business that might be in those other environments because they came in through an acquisition or because a particular cloud vendor is not available in that area, or again because you're not able to move data from from an on-prem cluster from there. So is there a benefit also to the innovation side, because you can go after new use cases and new parts of the business that are operating which have data in other locations?
Yeah, absolutely.
Or is it primarily for the risk and regulatory benefits? Or indeed, we really should just be viewing this as, well, it's for multiple sets of benefits?
It's both, really. Honestly, predominantly the thing I'm seeing is more around a regulatory perspective, because people want to do lots of cool stuff with data, but they're scared to do it because they know the regulations are coming. And so there's this inertia that they're overcoming. They're starting to overcome it, but they need to start planning now for the regulations that are going to be in place 3 to 5 years' time. Because anything that's designed now, it's not going to be able to change in a year or so. You need to architect for the future. So we need to architect with that in mind. That said, the whole choice of location, of multi-cloud, hybrid cloud, etc., that choice of movement, and more to the point, the control of movement within specific guardrails, the rules that you put in place that are not necessarily technical rules, but they could be political or regulatory rules. If you put those guardrails in place, you can then democratize access to your data scientists. Because at the end of the day, a data scientist doesn't want to know the rules of the world to understand what he or she can put up in what place. They want to do a cool, data model and press go and have it run. And so it should be up to the platform to protect the data scientists to run things. So if I take a very obvious example, if you're in Switzerland, that's a classic example that everybody comes up with. There are certain laws that pertain to Switzerland. Therefore, if you want to act upon that data, where does it have to run? Who has to manage it? And it's all down to the sovereign cloud sort of conversation. So if I'm running a data science team, I want to give them ubiquitous access to it. But if they're running something that is being tagged with Swiss data, it will only run in particular places within the rules and regulations. So it's all about putting, I guess you could call it just, business logic around it as opposed to technical logic and feeding that in. And it's all down to choice at the end of the day.
Well, there's a constant narrative around, wouldn't it be wonderful to let data scientists be data scientists? And Peter, I guess I'm curious, again, as the only person I know who already back in 2007 was taking a degree that was explicitly in data science, I'm imagining what they didn't bring up in that course was just the degree to which we're expecting data scientists to become experts in regulation, experts when it comes to certainly data engineering, but even also occasionally data governance, not to mention all of the other things that we like data scientists to be: consultants, great communicators, maybe their own front-end developer, et cetera, Curious whether or not you're seeing a demand or a aspiration from data science leaders and their teams to be able to abstract away the data science teams from questions of, well, where should I be training this particular model? Where should I be locating this particular workload?
I think that it's still protect the data scientists is still sort of the way, the guiding principle, I'll say it that way, and continues to be. I don't know whether that'll change. I was actually just thinking, I wonder whether in graduate programs now they are getting people to think. My guess is no. I mean, you're learning the skill set and the philosophy of data science, but you're thinking about it, I don't want to say in a vacuum. That's going too far, but to some extent in a vacuum. You're not. I mean, data governance is a slightly different question. That is a part of it, I think, but even that, it's data governance only from a can you build the cool model that Paul's talking about? I often think about, I had a mentor that I was building a model. This is no AI or ML involved. This is Excel. We were using a couple different programs, but I was building this model, and one of my mentors said, listen, all models are wrong. The only questions you're trying to answer as you build a model, well, you're trying to do it effectively, but are how wrong is it? How useful is it to the audience you're building it for? And how defensible is it? And those were his words, but I think they work, right? And defensible might have sort of evolved into explainable. Not that explainable AI is a unique element of it, but I think there's an element, because they didn't mean defend in like a, cover your rear end sense, although there's a little bit of that, but also really just, can you, when you explain the model, the choices about the inputs, the choices about the calculations, all the aspects of it, can you explain the decision making behind that? In some cases, the business rules behind it. Data scientists themselves, and I would argue their leaders, the management, the teams, the folks that manage directly the data science folks, I think they're still trying to protect the data science teams and their efforts, right? Not the individuals, some of that, but also really the things they're working on from all those certainly geopolitical questions. They don't want to be answering that kind of thing, but even things like where it lives, like on-prem versus cloud. I don't want to be making that decision. So I think that's still the name of the game. And if I had to guess, which no one asked me to, but I'm going to do it anyway, I think that's going to be true for the foreseeable future.
It feels like we're going back to Paul, your point around the industrialization of data science. So moving from what seemed to be a model of an individual Renaissance person being able to do all aspects of the project development and operationalization, working with often homemade tools on a very ad hoc process that varied from project to project, and leading to a piece of artwork which maybe worked well, but then was never really modified or improved on, retrained, etc. And moving from that to division of labor and specialized tooling and process discipline. Is that fair to say?
Very fair to say. It's all about the confidence factor. It's all about industrializing. However, it's all about doing that, but without impeding the velocity of the data scientists. Because at the end of the day, they're in it, they're there to help their business. And we do not want to impede them. In fact, we want to help them by making their decisions more repeatable, making their models more repeatable. And if you industrialize it, you can pipeline it more. And one thing I didn't pick up on earlier that I just want to put in is, if they've done something in, pick your favorite cloud, and then they want to industrialize it, and then they maybe they've got a budget because they're onto something here. So it's no longer a pet project. They might then want to get access to a whole bunch of GPUs. So that's something we didn't touch upon. And that's part of the conversation that we can have as well. You can either use GPUs in the cloud, which are moderately expensive, as we know, but you get what you pay for. Or once you've industrialized it, there are ways in which you can have a pool of GPUs to really crank that model and make them more quickly, so you can get time to value quicker of said models, but you can democratize access to that through the various tools and everything that we're talking about. So a data scientist, frankly, shouldn't need to know that they're coding to a model. They just know that when they press this button for production, it gets a little bit more expensive for them in terms of, I've got to have various resilience and things built in, but at the same time, it runs really quickly. I get my answer in half the time. I haven't got time for a cup of tea anymore. So that's a really good thing for them. So we don't want to impede the data scientists, but at the same time, we want to protect the data scientists.
Yes, on the Domino side, we're seeing a fascinating pattern whereby our most advanced customers, when it comes to deep learning, are pulling their deep learning training workloads onto on-prem GPU clusters because of the cost that goes into those. So we're seeing, particularly on pharmaceuticals, we're expecting to see it more on the financial services side as organizations both leverage more on the deep learning side, especially on the insurance side in particular, seeing it on all of those computer vision use cases for damage estimation. And so it's an interesting twist on the standard hybrid cloud story, because we usually don't think of repatriation of workloads in the context of that maturation, but it is happening as organizations get more sophisticated.
Absolutely, it's all about efficiency. So it's about running things in the most efficient way, and that incidentally ties into an ESG story as well. That is again regulatory led. But not only is it regulatory-led, the ESG story, but at the end of the day, it also comes down to dollars. Because if you're using lots of carbon, you're burning lots of electricity as well. And again, I'm from Europe, as you can tell. There were discussions about rolling blackouts across certain areas of Europe. So if there's a very, very important business calculation that's running on a regular basis, I might want to move that to Scandinavia, or something along those lines. It's about having that agility to adapt to what's going on. There are even conversations about, follow the moon sort of running, because if you're following the moon, therefore the electricity is cheaper. That's a whole other conversation that we can get into. But there are very, very clever ways in which we can help the data scientists run their jobs, but in the most efficient and compliant way possible.
It's a fascinating topic. It sounds like it boils down to having that agility and flexibility. You need it for regulatory reasons. It sounds like you need it for just reliability and robustness reasons, business continuity reasons. You need it for cost optimization reasons, and it sounds like you also need it for innovation reasons as well.
And apart from it being regulatory led, it's the right thing to do to run your business that way, because as a bunch of data scientists, people will know you want to de-risk your business to a great extent. You want to make the right decisions. And doing this, it's all common sense. The regulators are just helping people move in that direction.
Well, thank you. One last question, if you'll humor me. we are moving into a period of increased volatility, a risk of both fluctuations in macroeconomic conditions, strong risk of recession. Is there any piece of advice that you are giving on a regular basis to leaders on the financial services side and insurance side on what they should be doing in order to be able to not just survive but also thrive in these times of uncertainty?
Interesting question. Yes. And you won't be surprised to say it's about choice. In these days of, in this environment that we're in, it is anticipated that M&A is going to step up. Things like along those lines. I know that's not strictly around AI ML, but if you want to manage things in a very efficient way, you don't want to be managing 10 different environments. You want to have a single pool of people that will manage things in a very efficient way to provide access to your data scientists and give yourself as a business the choice to be able to move where you want. This is for the kind of the run the bank sort of process. But how you change the bank and how you innovate and evolve, you still need to have that flexibility. So the flexibility to spin things up in a cloud environment and then, play with it, see what works. So it's a fine line between flexibility, resiliency, etc. But my advice is just to look 3, 4, 5 years out and plan accordingly.
For me, there's not one piece of advice that I give to financial service companies specific to data science or AI or ML. What I would say that's very related, in fact, I'm glad you asked this question because it's a great question and it leads me here. We are speaking a lot with FIs, with financial institutions, financial service providers, about taking a hard look at what IP you need to own to drive growth. And IP, there's a lot of different kinds of IP, obviously, but that includes data models. It includes algorithms. It includes a lot of the stuff that, and banks aren't. Banks are good at lots of things, even though it's easy to make fun of them. Financial institutions are good at lots of things. They haven't really. That has not been something they've thought a lot about in their history. And your M&A point, Paul, is a good. So if you're going to get gobbled up, there's nothing you can do about that. But if you're looking at which M&A decisions you're going to make, right? If you're in the driver's seat, to get sort of corny about it, you do want to be thinking about the IP that you could potentially pick up. M&A is hard to do well, but it can be worth it if the IP that you're gaining out of that is going to drive growth, Paul, to your point, for years to come. So I think that would be, we have a report coming out called "Which IP Do You Need to Own to Drive Growth?" and that's right in there. It's not exclusively about this topic, but it certainly includes this topic.
Well, it sounds like the question of build versus buy, which often is more of a build versus buy versus hire, and it sounds like where the direction you're going in is, like with so many things, it's not one or the other. It's arguably all of the above. And when it comes to data science, machine learning, and artificial intelligence, there's a lot of IP there that you're not going to be able to go in and buy, or you're not going to get the value of going in and buying it if you're looking to work with professional services firms to quote unquote hire those kinds of solutions. You worry about IP risks there. But it sounds, what I would take away from that is that you can't avoid building your own, to a greater or lesser extent, your own data science and machine learning capabilities in-house, because otherwise you're not going to be able to either develop or protect that IP. But again, I hope I'm not putting too many words in your mouth. Was kind of that what you were going for?
I think that's true for lots of companies. I mean, I would add, like any analyst, that it depends, and I can talk about some nuance to it. But yeah, I mean, broadly speaking, what you just said is absolutely true for lots and lots of companies that I work with.
Well, Paul, Peter, thank you very, very much for your time and all your expertise on this topic. For our audience, please don't hesitate to get in touch with us. Our email addresses are here. We would love to hear from you. If you're interested in the ability to develop hybrid and multi-cloud capabilities, please come take a look at the Domino Data Lab website, where we have recently launched our new Nexus capabilities that enable organizations to both develop and operationalize data science, machine learning, AI models across the organization, across clouds and on-prem environments. Thank you very much.
Thank you.
Thank you.